what concerns me is I'm not sure people are aware of the three risks. We have inflation risk. We could see interest rates coming down dramatically, and we could see tax rates going up at the same time.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood, and I am back on Money Isn't. And I wanted to dive into a concept today that woke me up early and has me concerned. And I just wanted to spend a couple minutes framing this conversation. We rebranded this podcast a few months ago. We've done, I think we have 35, 40 episodes already recorded. And what I'm seeing in the feedback loops is a lot of narrow thinking, right? And what people don't really understand is that every variable in the wealth plan, when you change one variable, you get a different outcome. And what people don't really see is they don't see the tail. And when I say tail, what's its impact in your financial future? And we run this concept called an exponential curve, right? The wealth curve is about the impact on your plan, and small little moves either help the curve trend up, trend sideways, or trend down. And sometimes those are market conditions. Sometimes those are spending conditions. Sometimes those are things out of our control. They're black swan events. I have a wonderful video somewhere on the channel that's 3 minutes and 22 seconds called Financial Planning, the Big Picture, that I run through like 35 different financial pressures in about 3 minutes and 12 seconds. My voice was sped up at 1.2 times. So, I could speak that way, but I like to speak a little slower. But there's a couple things that are happening, right? The conversation right now is about inflation, and it's about the Fed funds rate, right? So we have two things that are competing and two variables that are competing, and it's creating an environment that I'm not sure people are really prepared for. And my goal of the conversation today was to put something in context, right? Because what you have is, not only do you have an interest rate risk happening, you have an inflation risk happening, but you also have a tax risk happening, okay? And what I wanted to discuss here is, you could be on the accumulation phase, you could be on the retirement enjoyment phase, or you could be on the later phase, which is the crappy, I'm in a nursing home or whatever, and I'm going through this, okay? Or you're just passing money, right? The position here is, and I have a simulation up on the wealth curve, but it's literally a person who is 65, they have $1 million, and that $1 million happens to be in cash at the moment, right? And what I wanted to focus on is, short-term interest rates 24 months ago or less were really low, and money in the bank was making less than 1%. Right now, money market funds and CDs and savings accounts are in the mid 4s to low 5s, right? And that feels really, really good. That's been a fabulous benefit of the high interest rates. And we have this issue, what's going to impact that dropping, right? So I wanted to think about this for a second and say, my goal is always to take things and connect them together to understand the impact. The way I view the impact is, what am I trying to really achieve in the planning process, which is money moving forward all the time, right? Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. So in this example, I just have a Social Security of $40,000. I have $1 million of money sitting at 5.2% in a money market account. I have a 25% effective tax bracket, which might be high, 5% for New Jersey, and a 20% capital gain rate. So when you look at this, what you're looking at is, if I have the $1 million, I want to go to the 1 year out. If I have the $1 million, it's producing about $50,000 of interest. Social Security is coming in about 40. So I got about 90,000 coming in. I've got about 23,000, 25,000 going out for the taxes. And my lifestyle cost, let's say, is $60,000. But bottom line is, I'm actually adding some money to the plan. The reason why the account's under it's 981. In the first year, there wasn't any Social Security, and we're still spending the 60K. Okay. But the reality is that, like, okay, I am positively saving money, and I'm feeling really, really good about that. Right. So what I'm looking at here is, if you look at the inflation chart, we're ticking down into the 3 range, right? The headline CPI number for July is below 3%. We're getting back into it. But the problem was, up until 2020, we were sub 3%, 2.5%, really, really low numbers for a very long time. And then we got that 9% bounce. And now what the chart looks like, inflation is coming down. But is inflation coming down? Inflation is still moving at 3%. And what's happening is, when you look at the components of inflation, energy is coming back off. Shelter is still a very high number. Core goods, food, you can see this chart where the colors are basically saying there are things that are in, negative inflation that are pulling inflation down. But overall, the inflation rate is still high, but it's not as high as it was. But the problem is, if I had, and I'm going to zoom out for a second on this, right? Because when you look at the curve, if inflation is 3%, you now start to see that curve, the lifestyle is now trending downward, right? If inflation is really, if it stayed at 9%, the person's running out of money by age 80. If inflation is 5%, it's here, but that's not really, like, the long-term side of this thing is not really the issue. But what I wanted to show you here is just this one little move of inflation being 5% drives, to have the same purchasing power, I've got to have $63,000 worth of lifestyle. So now my bottom line, which was $5,500, is now getting eroded, and I'm in this 20, and now only putting away $2,500. So now I'm beginning to erode the capital, right? Because the taxes are staying the same, and I'm now starting to lose capital. So what's happening is, when you start to think about benefits and structure, if I had a 9% inflation, that's like 3 to 4 years of inflation in 1 year. And now it's only going up 3%, but it's compounding off the higher number, which is destroying many, many people that I'm encountering as they come in. They're really getting hurt by this inflation, right? It feels better because they have the 50,000 of interest that they didn't have 6 months ago. But when you look at the Fed fund decision right now, the overnight fund rate is like 5.3. We're all hearing that the interest rates are going to come down. I did a presentation recently about this, where typically that Fed funds rate is 100 basis points lower than the 10-year Treasury. The 10-year Treasury was 4.6 a couple months ago. It's now 3.6, 3.7. So that means interest rates should be, 100 basis points is 1%. It should be 2.8. It's at 5.3. So there's a lot of room for interest rates to come down. Now, as those interest rates come down, that's going to cause the money markets and the savings accounts to come down. Okay. So when I start to think about this, if next year I don't get a renewal at 5.2, I get a 4, which could go down even lower. But I just want to show the example here using the same 66 time frame. I'm now looking at this. My interest dropped to 38,000 from 50. My taxes went down, but I'm now eroding my bottom line by 6,000. I'm digging into principal. And if that trend continues, I'm putting more pressure. Now, 16 months from now, 15 months from now, the 2017 Tax Cuts and Job Act will expire in 2025, at the end of 2025. So that means we're going backwards and tax rates are going up. Okay. So if I get this same issue where, hey, taxes went from 25 to 27, just to show that, you can see already that wealth dropped dramatically, right? So now the speeding up of running out of capital. But if I look at this on this zone, that tax is now causing me to dig into my bottom line by $7,000, right? So what concerns me is I'm not sure people are aware of the 3 risks, right? We have inflation risk, which inflation, depending upon the policies and things that are going to come over the next few years, inflation could run away again. We could see interest rates coming down dramatically, and we could see tax rates going up at the same time. For people that are retired, that accelerates their spend downs, potentially. For people that are in the accumulation phase, it has the same impact because it's going to squeeze your ability to save. You're going to have less discretionary money because you'll have higher taxes, less interest, and, potentially not getting out of the grocery store for anything less than you currently are. So my purpose of having this conversation is money is not limited to one factor, right? Money is impacted by multiple factors coming together at all times, and a plan needs to be thinking about all of these decisions at the same time. If it doesn't, it's setting it up for what I'm going to call failure. And that anytime you're in any one particular strategy by itself, you run the risk that that strategy is not going to perform to expectations, or it's not achieving what it wants, or you have a down market, you're forced to take more risk. You really need to understand, how do you position your capital so that you sustain this beautiful lifestyle that you want, or you need to readjust. And I'd rather readjust while I have money than readjust when I don't, or I'd rather come up with a better strategy to help me spend more money. There are cases and situations where if you redesign it, you could actually increase your spendable income and not run out of capital. And that's really good planning. So I want to thank you for being on this short podcast today, but I wanted to make sure that you understand it's not one variable that's going to impact you. It's going to be 3, 4, 5, 6, 7 variables coming together. I didn't even talk about technological change, right? I didn't talk about planned obsolescence. The dishwasher broke and I got to go, replace the dishwasher. I didn't talk about style changes. I didn't talk about all the things like, hey, I got to get a car that has better looking, or my shirts are out of date and I got to get, a nicer shirt, or whatever, right? There's all these variables. So I just want you to open your thinking and think about the variables that are going to impact me. How can I mitigate them today to take better action so that when these things potentially happen, am I properly navigating through that environment? Do I have the right tools set up at that moment? Thanks for listening. Hope to talk to you soon. Thank you.